As we all know, financial statements have been very important and crucial to our lives, to everything that we do today, to everything that lies in business. So attendees, as you can see my screen, we have a very interesting session starting up with some nice spicy thing to start off. So we have the icebreaker questions on the screen. So attendees, if you can answer them for me in the chat box, I'll be more than happy. So we have the icebreaker questions here. The first question goes like, do you believe money can't buy happiness? Why or why not? The second icebreaker we have, which says when money comes into your life, what's the first thing you want to do with it? Spend it or save it? Or just give it away? We're all liberal beings after all. The third question in the icebreaker, dear attendees, we have is what do you refuse to spend money on? Oh my God, this is a very tough question, I think. But I think all of us have an answer. And we also have the chat box where the attendees have been answering. We have got very interesting answers. So Ahmed Bashir has to say, no, cannot bring all the happiness. That's very correct, Ahmed. That is a very crucial thing. Attendees, if you can see my screen, please answer the icebreaker questions for us until we have the attendee list getting flooded in. Welcome everyone. Welcome on behalf of Uni Athena for the webinar today on reading financial statements like a storybook. Hello everyone. Hello everyone. Okay, somebody says that he'll be investing the money. That's very good, very correct. So attendees, if you can see my screen, we have got a nice icebreaker questions. Hello everyone. I'll save money in the capital. Someone says that's good. We'll now let's just see how we invest into capital. We have got very good insights today. Yes, money can buy happiness. Sharon says good day. Hi, good day, Sharon. Alan says yes, money can buy happiness. Yes, it does. Okay, we have few more answers. We have answers flooding in the chat box. So welcoming everyone on behalf of Uni Athena for the webinar on reading financial statements like storybook, financial analysis. So we have good answers coming in, attendees saying we can invest. Money can buy happiness. Yes, it can. Only if it is invested well, I think. So happy to hear from our attendees joining in and flooding in. Question 2 will do a bit of all three. So Christopher has to say that he will be doing a bit of all three very well, Christopher. Okay, attendees, I think we are nearing the session, the start of the session. So attendees, let me give you a small brief on how the procedure, how the webinar is going to go. Okay, so we'll have a session where our panelist and esteemed guest will be going to enlighten us with his expertise, with his knowledge on what is happening in the outside world with respect to the financial analysis and of statements in accountancy, I think, which is very inevitable for us to understand. Powered with that, we have a good Q&A session where all your question and answers will be answered after the session itself. So we'll be picking up the best questions and we'll try to answer as much as possible. Okay, and then we'll have a session where we have subject related polls or topic related polls where we want all our attendees to answer them for us, and we all will have a very good time, I assure you. Okay, so I'll just stop sharing my screen now, and I'll go ahead with the introduction that I'm supposed to give. Okay. Okay, so attendees, as you all know, a very warm welcome to the attendees joining us from the different parts of the world. Okay, so dear attendees, we are Uni Athena, and today we are gathered here for the webinar on reading financial statements like a storybook. Yeah, exactly like a storybook, because we have been wondering and seeing financial statements throughout our lives in any of the magazines, financial journals, and when we are just trying to figure out what a company is up to, if we have invested in any of the portfolios, figuring out where our money is going, what will be the returns, we need to have a lot of exposure on this, because when we are inclined to finance, it all together falls in a place. Okay. Now, attendees, as I'm sure you all are very excited, let me introduce myself. I'm Ankita, your moderator for today's webinar, and joining with me is Mr. Shyama Prasad, our panelist and faculty, who will be enlightening us with the knowledge and expertise that he has with respect to financial analysis. Now, dear attendees, as we all have a curiosity for knowing how to analyze financial statements we come across, we'll have it more simplified by our faculty, and we can always we can take a lot of takeaways from here to add to our knowledge base and to understand what it feels or what it means actually. So without much further delay, I will request Mr. Shyama Prasad to share his screen, introduce himself, and start the webinar for us. Attendees, please keep engaged yourself. Also, try to participate in the polls. Okay. So over to you, sir.
Ma'am, can you hear me?
Yes, sir.
And
we can
can I
hear you.
see? Yeah. I shared. Can you see the screen?
Yes, sir. We can see your screen.
Can you see the screen? Yeah. Okay, great. So
Sir, we
welcome
cannot
people.
see a
So we are going
PowerPoint
to have a nice.
presentation.
Oh,
Okay.
okay.
Yes, sir. Yes, sir. You can start.
Yeah, just one second. Check. Yeah.
Try
So
scrolling the
welcome
slides.
people.
Yes.
So I'm Shampar. Yes, yes. I think yeah, it's working, ma'am.
Yes.
People. So I'm Shyam Prasad, and I'm an ACCA member. I'm a SEMA member, and I've also done my MBA. I'm a gold medalist in finance specialization. So I've been like teaching around throughout India for the last like 15 years, and I specialize in stock market investment and investment analysis, accounting, and financial management. So that's my specialty here. So today I want to like tell about a very interesting thing which I feel it's like very curious. Okay? So that's about like statement analysis, but reading it like a storybook. Okay. So normally we would have attended a lot of webinar, seen YouTube videos, and we always talking about what statement. How to read it, how doing and all difficult to track. Okay. So why can't we and why can't we like explain it like a storybook, right? So created this kind of a presentation. Plus I will tell you like how you also could read further what to say financials in the same way I do, right? So once you've gone through this 1 hour webinar, I can assure you that you'll get a good grip like how to read financial statements, and that too like a storybook. Okay, that means you won't get bored by reading financial statements. Okay, so I've picked out like 3 companies here. Okay, I picked out 3 companies. So in that 3 companies, 2 companies I will explain, and one company, the last company, you guys can explain. Okay, so I'll ask some small questions, and you answer me, and then we will slowly like proceed to the what to say the proper kind of an answer, right? So what are we going to like look in today's session? So we'll be like covering these topics. So we'll be like covering, just 1 second, I'll change my pointer. Okay, so we'll be like covering like what is financial management. Number two, we'll be like also thinking about what is financial management decisions, and within that we'll be like looking at 3 financial management decisions. Okay, financing, investment, and dividend. So first, to give you a brief idea about like this subject or the idea called as financial management is, see, it's not like applicable to an individual. Okay, it's not for a person, it's not for a family, right? It's not for a small business also. It's actually for an MNC kind of a big business. Okay, of course, like small businesses can use this, but it's typically the subject has been created for the purpose of like big companies, and that too for listed companies, those companies which are in the stock market. Okay, so that is where the subject is being like put. Okay, so contextually that is the idea here. So the three companies that we'll be like looking in today's cases are all Indian companies, but I'll give you a like brief idea about what this company is, so that you will also have an idea like, okay, about that industry, about its products and stuff like that. So you also can tell me like how this industry will, how this company will perform. Okay, so I will tell you an idea about the company, what the company does. You can tell me like how the profitability will be, how the sales will be. You can tell me. Okay. So 3 companies I have taken: Paylite Industries, Jet Airways, and Sun TV. Right. And finally, we will look at like the relationship between the subject and something called as a share price movement. Okay. So this is what we are going to look in today. So first we'll start with this idea about like what is this subject about. Okay, so financial management is defined as the management of the finance of an organization. Okay, it's all about like how we manage our finance. But why do we manage that finance? We are managing that finance so that our financial objectives of the organizations are achieved. What is our financial objectives? Okay, our financial objectives are going to be we want higher profit, right? We want uh, a lower debt equity ratio. Okay, we want a good working capital management. So this is what we actually want. Okay, so achieving this, achieving good profitability, stable business, okay, stable debt equity ratio or lower debt, and finally like properly managing our working capital. Okay, so this is our objective. So the objective of a private sector organization, that is a company which is aiming to have profits, okay, their objective is nothing but to maximize shareholders' wealth. Okay, so maximizing shareholders' wealth is our share price should also be higher. Okay, so our goal is first, our primary goal is to have the share price higher, to have profitability, to have a proper debt equity ratio, and to have good working capital management. Okay, so these are our main goals in financial management. Okay,
Mr. Shamaprasad, can I interrupt you
yes,
for a
ma'am.
minute?
Yeah,
We are getting
yes.
messages from the attendees saying that you have to be a bit more louder, and your voice is cracking in between. So just
Okay.
if you can wear an earphone,
Yeah.
that would be okay.
Yeah. Okay, ma'am. I'll just like put it here so that it's like quite easy. Okay. Let me know if you have again the same problem. I'll try to adjust my mic also. So my mic got I'll change it and go ahead.
So I think there is a problem with the internet connection because we can barely hear you.
Okay. Then I'll change the internet connection. Give me one.
Yes.
Okay, it gets connecting. Okay, I think it's connected, ma'am. Can you hear me now, ma'am? Is it better?
Yes, we can hear you now, so clearly.
Oh, okay, perfect, ma'am. Okay, so that's about here the financial management. So from here on, we will move on to the next kind of an idea. See, there are three things which are interrelated in financial management. Okay, so if you are a large company, okay, see, think yourself as the CEO of a large company. So something like a big, it can be a multinational company or a very big kind of a, in your country, it's a big company. So in these companies, how they think about finances in three ways. Okay, number one, from where are we going to get the money, right? So from where we are going to get the money, that's called as financing. Where are we going to put that money? Okay, that's called as investment. And once you have invested somewhere, definitely it will give you a return, right? So that return is the profitability, right? What are we going to do with that profit? Are we going to use that profit again in investment? So your investment gives you profit. That profit is also used as a finance to invest again. Okay, are we going to like reinvest the money, or are we going to like share it with the shareholders? Okay, so from where we are going to get the money is financing. How we are going to invest that money is investment. How we are going to share that money is dividend. Okay, so dividend is it is how much of money. Okay, assume that we get a profit of 100. Are we going to give all the 100 to our shareholders, or should we like retain all the 100, or should we like go for a 50-50, give 50 to the equity shareholder and 50 we can retain in the company? Are we going to do that? So these are three decisions which are like interrelated here. Okay, so this is where the storybook concept actually rises, because we don't need to study this like a theory concept. We can actually read it like a story. Okay, so I'll give you a quick idea about like what is an investment. Okay, see, in an investment in a large company is they can invest in a new machine, they can construct a factory, they can put it for their daily payment requirements, that's called as working capital, or it can be for merger and acquisition. Okay, they can buy with this money, right, some other company or some other business. So that's like merger and acquisition. So this is about the investment part. So what about the, okay, okay, so what about the financing part? See, before like investing the money, we have to raise it somewhere, right? From where are we going to raise it? We can raise it from debt. Okay, we can get it from by issuing bond or getting a bank loan. We can get debt. We can issue shares, through that we can get, or through retained earnings. If we make profit, from that profit also we can again put it into business. Okay, but there's a danger here, right? There's a danger here. The danger is if you go for too much equity. Okay, if you're going to issue 100% of all your shares in the equity share market, then who is the majority owner, right? Who is the major owner? No one, because all the 100% share is like sold to the share market, right? That means you should not sell all your shares in the market. Even if you're a CEO, or even if you're the founder of the company, you should not sell all the shares in the share market. You should hold something like 40%, 50%, 60%, like that you should hold. Okay, the ideal thing is you should hold at least 60%. Okay, so that is about equity. Don't try to sell all your shares in the market. Okay, see, this is I'm telling from, if you are the owner of a company, then you should have 60% of the shares in yourself. The 40% you can sell it to the share market. Okay, from there you will get the money. Okay, so what about debt? See, the problem with too much debt is the higher and higher and higher the debt you go, the more and more interest you have to pay. So even if your company is profitable, they cannot like pay the interest properly. They cannot repay the money properly, and they will be in trouble. Similar to how financially mismanagement we do. Okay, we get a loan, we can't pay the interest, we get another loan. Okay, to pay that loan again we get another loan. See, how we complicate things in life is the same way how companies complicated in life in its existence. Okay, so money for a company can come in three ways: debt, equity, and retained earnings. Once they have got the money, the second problem is where to invest. So that I think we've already discussed. The third part is we've got the money, we invested, and we are getting some profit. What are we going to do with that profit? One, if retained earnings are used, it will reduce the dividend payout. Okay, so if whatever profit that we are getting, if we use all the profit, okay, if we are going to put away all the profit into retained earnings, then we will not have any dividend payout. Okay, See, if we issue a lot of debt, then we won't even get much profit. The problem is all our interest will eat all the profit. Then only little amount will be left for equity shareholder. If we issue a large number of equity shares, the company might earn profit, but the profit has to be shared by additional shareholders. Okay, so more shareholders will be there, and they also have to share the profit. Okay, so these are the problems here. So how are we going to solve all these tricky problems? If you adjust one thing, the other mechanism will also adjust. So it's something like an engineering concept. Okay, you change financing, it will affect investment. If you change investment, it will affect the dividend. If you change dividend, it will affect the financing. So all are interrelated. So this is actually the theory stuff. Okay, from here on we are not going to do theory stuff here. Okay, so you guys have been like following for a bit of time. Okay, so you guys tell me what is the answer for this. Which of the following is least likely to fall within financial management? A, dividend payment to shareholders is increased. B, funds are raised to finance an investment project. C, surplus assets are sold off. Or D, C, spending on CSR activity. Which could be the answer?
Attendees, we have a very interesting question
So people
by
can,
the
if you can,
faculty. So we want you to answer the question so that we understand how well your inclination is.
okay, one of you has put D, one of you put A. I think with 3 more answer, I think we'll also move. Again, it's D. Okay, some of you tell it's C and B. I think majority is like revolving around D, it seems. Okay. See,
Yes,
so
yes.
yeah, so D is the answer. Okay, why it is the answer? Okay, why D is the answer? See, if you look at here, the dividend payment, okay, dividend payment is increased or decreased, it will affect the finance position of the business, right? It will affect the financial position of the business. B, funds raised are to finance an investment project. Okay, so this is an investment decision. Okay, so should we put the money in the project or not? It's an investment decision. Surplus assets are sold off. Is it a financing decision or an investment decision? It's a financing decision. Okay, we want to construct a factory. Okay, so what we do, we sell off all our old assets or surplus assets. Okay, with that money we are putting it in the construction of a factory, right? So for example, we want to buy a house. What we do, we might sell some of the gold or jewelry that we have, okay, or some of the shares that we have, we sell it and we use that money to buy a house, right? So that means we sell one asset to get money. Okay, so it's a financing activity. So this is a financing activity. But what about CSR? See, CSR is a we spend money on that, but is it going to like make us financially better in the future? The answer is no. Okay, CSR activities will not make us financially better in the future. All the other points, okay, dividend, financing, investment, and decision are decisions which will make us, okay, which deals with money, and with also we are trying to be much more richer for the company and as well for the shareholders. We are trying to become much richer. Okay, whichever is like making us rich, we are trying to do that option. But CSR is a community activity. It's a social service activity. So this will not fall under in the question. Okay, so
Sir, there are a few of our attendees asking us
yeah,
to elaborate on CSR. So if you can please elaborate a little bit on corporate social responsibility activities.
sure, ma'am. So what is the CSR activity? See, CSR activities is a company has some profit. Okay, sometimes government will insist that the company should spend a percentage of their profit or their sales for community social corporate social responsibilities. Okay, so construction of a park or a construction of a school, okay, government school, or construction of a hospital. So companies, okay, either voluntarily or by government push, they are spending for
Dear attendees, please bear with us. We are having some glitch. The faculty joining back again.
Okay, sorry, ma'am. I think I've lost the internet there. Yeah, is the screen visible, ma'am?
So you can share again.
Yeah, sure.
Attendees, by the time we have an interesting poll question for you, the method of calculating return on assets, which highlights the importance of sales, profit margin, and asset turnover is known as. So you can just answer the question, attendees. So I hope, dear attendees, there is a poll flashing on your screen. You can answer the poll. Okay, thank you so much, dear attendees, for answering the poll. So please, you can continue.
Yeah, yes, ma'am. Just 1 second.
Dear attendees, by the time I would like you to note that there will be a certificate being provided by us as a certificate of participation, which will be ultimately coming into your inbox after the live session ends. So you can expect it in a day or two.
Okay,
So attendees, basically, as we had the poll said the answer says.
just 1 minute, ma'am.
Dear attendees, you can please note that there will be poll session, there will be poll questions coming in from time to time. So I'll keep you engaged and we want you to answer them. The correct.
Okay, ma'am. So I'll start.
Yes, yes, sir, please.
Yes, ma'am. Yes, ma'am. Okay. So hope we got a good idea about what is CSR. Now we'll move to our storybooks. Okay. So storybooks works like this. Start with the first story, which is called as Paylite. Okay. So first I'll give you an idea about like what is this company, what are its products. Okay. So whether you know this company or whether you do not know this company, that's not a problem, because I'll give you a background idea about the company so that you get an idea like what are the product it deals with. Okay. So even if it's a company that you do not know, okay, it's actually good, because there is no bias you have towards the company, whether you like it or you do not like that. So I will tell you what the company's products are. Okay. So I'll show their products. Okay. So this is on Google. So what are the products that they are having? See, the product the company has is something called as Fevicol. Okay. So what is Fevicol? See, Fevicol is a adhesive. Okay, it's an adhesive. What type of adhesive? It binds woods. Okay, it's bind wood for wood things together. So it is used in all furnitures. Okay, it's used in furnitures. So how long the company has been in the market? I think it's around some 50 years in the market. Okay, their major product is wood adhesives. Okay, Fevicol. Then they have a product called as what Doctor Fix It. So Doctor Fix It is whatever like plumbing solutions. Okay, whenever we have to use a paste, okay, or some adhesive to ensure water leakages doesn't happen. Okay, pipes and all. We use Doctor Fix It. Okay, and then we have MC. Okay, which is used in bathrooms and all. we have Fevistick. So Fevistick is a kind of a adhesive which is used by school students. Okay, so it's like a glue or a gum. Actually, glue stick. Okay, then there's hobby ideas. So hobby ideas is a paint. Okay, is a paint which is like water paint, you can say, or it's fabric paint. Okay, it can be like two. So these are their major product. Okay, these are their major product. Okay, if you say what is, we might think that this is such an ordinary industry, boring industry, okay, which is used by what, carpenters and plumbers. What is this going to be like interesting, right? It's like very boring uh, with carpenters and plumbers. Okay, how much money is this company going to make by selling this kind of a product? Okay, see, this company is actually a giant. Okay, why they are a giant is their brand is existing there for 50 years. Okay, so no other company, or I think every competitor or everyone felt that this is such a boarding industry, so why should we be in the market? But Pedialyte has been doing this for the last 50 years. Okay, selling adhesives. In what quantity? They sell it in small 5 ml packets, small packets. They also sell it in 1 liter, 500 ml, like 500 liters also they sell. That means it can even come in a truck. Okay, so the Fevicol might even come in a truckload. So they are able to do such a huge, see, across India, every carpenter knows this company, every carpenter knows this company, and they keep on buying only this company's product. Okay, so once you have got an idea about what the companies and its products are, because that's a key here, that's a very key here, from there on it's a storybook. Okay, I have given you a lot of clues, like there is like not much of competitors for this company. It's a 50-year-old company. All carpenters and plumbers love this product. They actually don't know much any other product compared to this. Even in the consumer mind, not the carpenter, even uh, when we want to buy a furniture, we, as a consumer, we check if the furniture is like used uh, Fevicol or Pedialyte products. Okay, because that's like best, that's the best, that's how we feel it, it's best. So what are the key numbers that we need to know from here? Number one, we need to know the market cap. It tells us how big the company is. It's like 1,36,940 Indian rupee. Okay, that means it's a substantial amount of money. Two, its share price is 2,694. Again, it's like substantial. In dollar terms, I think it would come to somewhere between $75. Okay, it comes to somewhere between $75. Another important number that we need to know is PE ratio. It's a very important ratio. It's not like rupee or dollar or anything like that. The higher the PE ratio indicates something. Okay, the higher the PE ratio. Normally, average companies might have a PE ratio like 20, 30, like that. Bad companies have a PE ratio of below 20. Okay, bad companies below 20. Average companies 20 to 30. Good companies can have an PE ratio of something like maximum 60 or 70. That's it. But look at the PE ratio of this company. It means it's not a good company. It's a amazing company. It's an amazing, amazing, amazing company. Okay. So that's what PE ratio indicates. So by looking at a PE ratio, you get a small element of a story. Okay. So don't see this as numbers. See this as characters. Okay. So PE ratio is like a guy. Okay, like a person. Okay. If he has like less than 20, he's a bad guy. If he's like between 20 to 60, he's a sorry, 20 to 30, he's an average guy. Beyond like 30 to 60, he's a good guy. But 60 above, he's an amazing guy. Okay, that's how PE ratio we have to read. And one more number that we all have to focus on is ROC, return on capital employed. What is return on capital employed? Very simple. You invest your money in a fixed deposit. Okay, in a fixed deposit, on a time deposit. So you invest $100. The interest rate is $5. At the end of the year, how much you will have? 100 plus $5, $105, right? This company, okay, for the capital that the company has, how much percentage it generates is around 25%. That is, in a fixed deposit terms, if you say, it is like 25% return this company gives every year on year. Okay, so uh, when comparing your fixed deposit and Paylite, okay, fixed deposit is like a bicycle and Paylite is like a supercar. It's that fast and amazing. Okay, see, overall this is an amazing business. That's an idea I think we got here. Now let's look at the financial statements. Okay, these numbers are very small. Okay, numbers are very small, but we can understand the story only through this. Okay, so hope you guys know what's a financial statement, because I assume that you guys know what's a financial statement. At least 4 elements you should know. Okay, we are only going to discuss about sales, operating profit, net profit, and dividend payout. Okay, only 4 we are going to discuss. We'll discuss from sales. What is sales? Okay, anything that we sell and the company gets money. That's it. Look at the company sales here. It started at 3,000 crore in 2012. Okay, from there 3,600, 4,200, 800, 5,300. It keeps on going upward. It's inching up. Okay, I think you guys can see it. It's inching up little by little. Okay, look at this company. The very key factor that we have to look in a company is when the sales doubles. Okay, when is it doubling? So this company doubles in 2018, right? So it took how many years? 1, 2, 3, 4, 5, 6, 7. It took 7 years. Okay, let's see how much times it takes to double. Okay, 6,000 has to become 12,000. I think roughly it's here 12,000. 1, 2, 3, 4, 5, 6. Earlier it was 7 years. Now it's like shortening by 1 year. Okay, that means the company is becoming 2 times big. So we'll put it like this. You get a salary of 3,000, okay, in 2012. That salary doubles in the next 7 years. Then that salary doubles again. Okay, so this number will get doubled or might get doubled in the next 6 years. Okay, it can get doubled in the next 6 years. Okay, that's so. What is the story that we are getting here? The company has a good sales. Okay, a proper sales, a smooth sales. Okay, in none of the year is it like falling down. See, is it like falling? No, even during COVID, okay, during what we say COVID times, okay, COVID 20, I think COVID 21, okay, during even that times, I think the company has not gone down. Its sales is not down, so it's actually equal. Okay, it's almost equal, so it's not gone down. Okay, it means that this is a solid company. Okay, it's a very solid sales company. But what about the profit? Profit is like we have to check whether it's like increasing every year. 485, 672, 1170, 1300, 1500, 1800, 2000, roughly 2000. Look at their profit. Now look at this curious concept here. When is this money getting doubled? Okay, we'll take this as 500. 500 when it becomes 1000, almost here. How many years? 1, 2, 3, 4, 5.
5 years.
In sales, it took 7 years to double. But look at the profit. It's doubling in 2 years. That's amazing. Okay, let's see how much it doubles from here. It doubles in 1, 2, 3, 4, 5, 6, 7, 8. Okay, in 8 years. There might be some problem. I think here they dipped. Okay, they dipped a little bit. Okay, it might be due to some trouble. Actually, there was some government ruling which came here. Okay, GST or goods and sales tax and all. So because of that, I think it would have gone down. See, leave like small turbulence in between. Okay, see, you are sitting on a plane, right? You sit in a plane and you take off from your hometown and you want to go to Paris. Between your travel, there will be some wind turbulence. There will be some turbulence. Okay, but are you arriving safely? Okay, and happily in Paris? The answer is yes. If that is what we want, in few years it is going to go little bit up or down. That doesn't matter here. Okay, that's about operating profit. Okay, so what about net profit? See, net profit and operating profit differs. Operating profit is our sales minus the production cost gives us operating profit. Okay, but operating profit and net profit differs in a place called as from interest and depreciation. It differs there. Okay, you direct two numbers. For example, you take here 485 is the operating profit. How much interest they paid? 31. They paid 31. Depreciation is like their machines get depreciated, their vehicles get depreciated. That is 64. Okay. How much they ended up with? 325. Okay. Is it a big deal? We have to check. We'll just check it.
Sir, can we call it profit before interest and tax also, right?
Yes, ma'am. Operating profit, we can call it like PBIT.
Profits before interest and tax.
And tax.
Yes.
So this number itself should be a good number. Then only the net profit number will be at least somewhat good number. So look at this one. Okay. So look at this place. Is the interest like substantially increasing? It was 31. Is it like substantially increasing? Okay. It's only 48. Okay. See, 31 is a big number when compared to 485, right?
Yes,
31
yes.
is a big number. But is 42 a big number compared to 2000? That's negligible. That means they have become,
not really.
they are, it's a very small number here.
Yes.
So the profit is also, look here, I think it's like doubling. 300 become 600 here. I think somewhere in between these here. 600
yes.
become 1200 again here. This is a solid, really good.
They have managed the interest very well.
They have managed the interest. Yeah, in many places they have done well. Sales, they are good. Expense, they are like under control. Interest, they have managed it absolutely well. Depreciation will incur because like, see, you have one air conditioner in your house. Of course, it will depreciate. If you have like 5 air conditioners in your home, it will have more maintenance and repairs, right? So depreciation, even if it's like higher, we don't need to much worry because we have to have more factories, more machines to produce the product.
Investment in assets, yes.
Yeah, investment. So it will depreciate. So a good company can share its money with shareholders. So are they sharing it? The answer is yes. See, dividend payout is out of this profit, how much they are giving to their shareholders. 30%, 31%, 32%, 42, 44. They are sharing a lot of wealth with the shareholders. They are, so you invest money here, you will definitely get dividends. Okay. So let's look at like one place here, COVID. See, during COVID, it's like March 2020 to 21. Have they shared wealth? The answer is even in the worst of the years, they are sharing money. Even in the worst of the years.
They have maintained a good dividend payout.
They are maintaining a good dividend payout. Okay. So we'll see one more thing, the balance sheet, and then we'll go to another company. So balance sheet.
Sir, sir, we have a poll coming up.
Yeah,
okay,
sure.
So by the time we move to balance sheet,
yes, ma'am.
Attendees, we have a poll being coming up on your screen. So the poll question says, which of the following is a method used in financial analysis statements? We have options as variance analysis, trend analysis, break-even analysis, or budget analysis. So you can choose the answer for yourself, dear attendees. I hope a poll question is flashing on your screen. Which of the following is a method used in analyzing financial statements? The answer is trend analysis. Few of the attendees cannot see the poll. Please relaunch the poll for them, if you can. Sharon Sam says, I'm not seeing the poll. Okay, so you can continue with the balance sheet.
Okay. Sorry. So just 1 second now. Just 1 second, ma'am. I think I'm getting some little bit of interest.
Okay, attendees, we can see majority of them have answered trend analysis. Which of the following is a method used in analyzing financial statements? So trend analysis has been answered as the correct answer for this poll.
Okay. Shall I start again?
Yes, sir. Please go ahead.
Okay. Just one second. I think I switched on. Okay. So we looked at what's the profit and loss statement. Let's look at the balance sheet. Okay. See, in balance sheet, we are going to look, might look very confusing with lot of numbers here, but don't worry. See, when we know like what to look at, we can focus only on that area and we can quickly understand the idea here. The items that we are going to see here are reserve, borrowing, fixed asset. Okay, these are the things that we are going to look at here. So why are these areas like very important? Okay, number one, as an individual person, okay, we have to look at how much of liquid cash you have. Okay, as a liquid cash, what is liquid cash? How much you have as it in gold, how much you have in shares. Okay, because why these are like important is you can quickly convert them into cash. You can sell your jewelry or gold, you can sell your shares, and you can quickly invest that money in something else. So that is what we talk here about reserves. Okay, you might also own a house, but houses are not reserved because house you have invested, right? So house is a fixed asset. Okay, it's a fixed asset. Okay, so reserve is from the profit. Okay, every year the company earns a profit, right? For example, if you take this year, okay, in 2013 they have earned how much? 422 profit. Okay, so in 422, sorry, 424, if you add 1270, right, and the 424, you will end up with this number. Okay, somewhere if it doesn't, they have done some accounting differences here and there. Actually it's coming to how much? 230, I think. Okay, it comes to 230. So sorry, I think you should add 325. Sorry, if you add 325 with the 1270, okay, will you get that number? No, it's this result. But hopefully you got an idea here. The idea is every year's profit keeps on getting added, 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 added. It gets accumulated. Okay, every year's profit. Okay, if you use that money from there, if you are going to use it from there, the reserve will decrease. Okay, if you use that money, okay, it will automatically decrease. Okay, but let's look at this number called as reserve. Reserve for this company, see here, it's always accumulating. You just have to look whether it's like increasing. We don't need to think about anything else. Is it increasing? The answer is yes. It means the company is like always having a continuous amount of savings. Okay, they might have invested this money in some assets also. Okay, so if your reserves are good, see, if you are making good profitability, that means you will have good reserves. If you already have good reserves, should you need to borrow more? The answer is no. You don't need to borrow much. But like, look at this company. It has 311, okay, borrowings in 2012. But look at here, it keeps falling, falling, falling. Okay, falls, and little bit it rises, and it's like little bit same. Okay, from 2012 to 23, it's same. See, now look at here. You have assets. Okay, you have like a reserve of 1,200 in your hand. You have like in one hand, you have like $1,300 or something. You have in your one hand, and on the other hand you have 300 of borrowings you have. Okay, so when you combine both this money can be used for purchasing some assets and stuff like that. Okay, but is 320 a substantial money? Yes, you have to, if you want to pay, your reserves will have how much balance? Only 900. That means it's a substantial thing. But look at in the 2023, okay, they have 7,000 of reserve, and in that is 400 a big money? Is 400 a big money? The answer is no. Earlier it was like 25% of your reserve, your borrowings were, but now it's like hardly like 3% or something. That means it's like substantially we have actually reduced. Okay, so don't only look at those numbers directly, also like check between the relationship. Okay, so the story works like this. This company has an amazing profit. Amazing profitable companies will have amazing reserves. If they have amazing reserves, they have like lower borrowings. They don't need to borrow. And with this, what they will do is to fund their purchase of fixed assets. Okay, how will they buy assets? They will buy with what? With the profit. Okay, so look here, from 600 they have 5,000 worth of assets. Okay, it's like 10 times they become big. Okay, it's like From one factory, they have like created 10 factories. Okay. But from where did they get this amount? From where did they get this amount? They got this amount purely from profits. Okay. The profit from 2012 to 2023, that profit is being used to construct or create assets. Okay. So it's like uh, you have a house. From that house, you got a rent. Okay. You have been like saving that rent for last 10 years. That money you have using to buy another house. Okay. You have not borrowed. So look at how it works here. This company is using their profit to purchase an asset. That's an amazing kind of a company. So you got the idea here. You are, without borrowing, you are buying a house. But how can you buy? Because your earlier house has given you plenty of rent. That rent you have saved for the last 10 years, and that rent you have invested in a new house. Okay. So this company has done that. It's an extremely good company. Okay. So that's about the story of Paylite here. Okay. So the sequence works like this. Amazingly profitable companies will have amazing reserves. Amazing reserves will, there is no requirement for borrowings. So with good reserves and no borrowings, you can easily buy assets. These assets will do what? These assets will further make you more sales, right? They will help you to make more sales. More sales leads to again more profit. More profit again leads to high reserves. High reserves leads to higher assets. Okay, so it becomes like a cycle. It's actually a cycle. Okay, we call it as virtuous cycle. Okay, good things leading to good things. Okay, so it's like good karma. Okay, good karma we can say. So that's about the good company here. What happens to the good companies? We leave the cash flow. Okay, we leave the cash flow. But what happens to the good companies? What happens to the share price and all? Okay, that's a curious kind of a question. Okay, so let's look at that. So this is the shares. This is the company's share price over the period of 15 years. Okay, I can say 17 years. Okay, this company's share price was around some 10 rupees or something. Now it is 2,500. It's like 250x. It has gone up. Okay, so it's not that you should have bought it in 2006. Okay, you should have bought it in 2009, 2012, 2015, 2018. Okay, even during COVID, if you have bought it, still you would have made money. Okay, it's an amazing company. If you want like an exact screenshot, I'll show you the share price. Okay, I'll show you the share price. Okay, it's loading. Just a second. Okay, so you can also check it with Google, in Google. So maximum time period I've clicked. It takes some time to load. It's taking some time. Okay, I think it will take some time. Okay, but hope you guys gotten a good idea. See, good companies you can buy it at any price, but the trick here is to hold it for a long time of period. Okay, you can buy this company even at this price, not a problem. Buy it, but forget it for the next 15 years. Okay, don't actively see it. See, none of these places, in any of these places, there is always an up and down. There's always fluctuations. There is always a up movement, down movement. Okay, see, if you see in this particular space, okay, it looks like a very, what to say, small place, but if you zoom it, okay, you will see the difference. If I think I could zoom it. I'll zoom it here. If I zoom it, the share price would have been a collapse. It's like from 500 to it would have been like 450. Okay, let's see. Yeah, it would have been from 700 to 600 or something. It's a major fall from 700 to 600. It's a major fall. Okay, but it is a major fall. Okay, but should we worry about it? No. That's only 100 difference, but look at the long way. Don't think it in terms of weeks, months, days, hours, and all. Think in decades. Okay, that is where you can make money. Okay, so even if you're a CEO of a company, you should think in decades. Okay, so or else we can't make money. So here you can exactly see here this company in 2008. I think that is where I showed you the share, uh, the price chart. So it was around how much? Okay, in 2008 it was like 87 rupees. 87 rupees. It's now 2,600 rupees. Okay, it's like 30 times it has gone up. Okay, you don't need to be a what to say, Harvard University brilliant person. You don't need to be something like what to say, a CFA, an MBA, or CA, or anything like that. Find out companies which will be there for the next 30 years. Okay, and then buy them. Okay, so the trick is in finding out the company which will be there in 30 years. So let's see how a company should not be. Okay, so that's a very important thing. Okay, how a company should not be, or which companies we should not invest. Okay, let's see this company's story. Okay, Jet Airways. Across the world, airways companies, okay, airline companies make loss. Okay, across the world. Only in few countries, exceptionally, they do well. Okay, for example, I think there's a company called a Southwest Airline. They do well. Ryan Airways, I heard they do well. Etihad Airways, they make some profit, I heard. But throughout the world, airline companies will make loss. Okay, throughout the world. Okay, if you want to check, you can also check that in Google. My Google speed is like very bad. Okay, just 1 second. Okay, bankrupt airline in world. Okay, let's see like how many airline companies have bankrupted. Okay, just for quick reference. Okay, list of airlines impacted by COVID. Okay, leave COVID, that's very specific, but okay, in last 10 years. We'll check. Okay, let it load. I think we'll, okay, in last 10 years. Quickly we'll see. Okay, it will take its own time to load. Okay, by that time I think we'll see our numbers. Okay, so this company, if you see their market share, market share is like the total shares multiplied by the share price. That is like 570 crore. Okay, see, it's actually not such a small company. No, this is actually a very big company. Okay, but why we'll see like why this is so bad. They do not have a stock PE. Okay, that should be some number, but that number is missing. ROCE number is also missing. Share price is there. It's only 50 rupees. Okay, looks like very low price. These are the major numbers we have to look. Okay, see, the one negative that we have here is like there is no stock PE, there is no ROCE at all. Okay, only two things we have. Okay, so at least with this, can we make any idea? Let's look at the numbers. Quickly, we'll see the numbers. Okay, number one, sales. Is it growing? Check. Yes, it's growing up to here. It's falling, growing, falling, destroyed. Okay, their sales is destroyed. From March 2020, their sales is like virtually, it's like wiped out. Okay, see, they got not only like due to COVID they lost it. Okay, it's they have a lot of internal problems. So let's look at their operating profit. Look at their operating profit even before COVID. COVID is only here. Okay, COVID started only from 2020. Let's look like before this. Operating profit is 19. For what? For 14,000 of sales, you will get 19 profit. Weird. 908 sounds very weird. From 20 you've gone all the way up to 900 in a year. Sounds extremely weird. Then this company makes huge amount of loss, again weird. Then it like minimized loss, maximize your profit, again profit falls, again profit falls totally. Okay, profit is like the loss is at the highest. Okay, in the last like 7 years. These are all pre-COVID numbers. Pre-COVID numbers. Okay. Post-COVID numbers, I think even if you ignore, you can easily figure out that this is the amazingly bad business to be in. Okay. So operating profit if itself is at a loss means what will be the net profit? Because you have to pay interest, there will be depreciation. Both are negative numbers. Okay. Interest is a negative number, depreciation is a negative number. That is like 19. From 19 you deduct interest, you deduct 940, you end up with where? Okay, you will end up with somewhere called as negative profit. So look at here, all numbers are negative except for this 2016 and 17. I think all the years are negative. Should you invest in a business like this? Pretty much straightforward answer is no. If the company is making loss, can they have dividends? No. Okay, see, now what happens here? This is a bad business because it makes loss. As it makes loss, it is unable to pay dividend. Okay, so let's look at their balance sheet because their P&L looks terrible. Let's look at their balance sheet. First, look at reserve. Reserve should always be positive. If it's negative, means it's a ridiculously bad company. And the larger the negative reserves is, it's a very, very, very bad company. Okay, so we are getting a lot of bad things in this company. Bad vibes. Borrowings. Look at borrowings. Extraordinary borrowings. Okay, extraordinary borrowings. Okay, because look at their sales in that year. Sales itself is only 14,000. Borrowing is 13,000. Okay, your borrowings is like more than your sales. It's like extremely bad. Look at borrowings. Every year they have borrowings. Even though they have reduced it. Their borrowings is like pretty much the bad story. So look at how many bad things are there. It's a loss-making company. Reserves have gone down. Borrowings are high, but they have managed it. The only managing it and bringing it to a lower number is the good thing. Okay, that was the only good thing. What about the assets? They had a huge amount of assets, but what happened? Assets are reducing. Either they are depreciating or the company is selling them. Okay, look, how will an asset depreciate from 8,000 to 5,000? Assets will not depreciate. The company is selling it. The company sold its assets. If you keep on selling your assets, okay, then what will happen? Assume that we start with 10 factories. You don't have money to run your business. Every year you sell one factory. Every year you sold one factory. Finally, you had how much factory? One factory. That factory also you were unable to run. You pledged that factory. You got a loan on that factory. Okay. If you're unable to pay the loan, what will happen? Someone will seize that factory also. So look at how terrible a story is this. Can you see how the story plays so bad? Okay. Volatile sales. Okay, volatile profit, or sometimes no profit, no dividend, negative reserve, high borrowings. Fixed assets is decreasing rapidly. Okay, that means it's a worst business. It's a worst business. Okay, what will happen to worst businesses? This is what will happen to the share price. From 1,200, it fell all the way around to 50. So if you have invested like 100 here, 100% here, you would have ended with 3%. So if you've invested $100, you would have ended with $3. It's like such a bad business. Okay, if possible, never buy airlines business. Okay, you can't make money here. So you got an idea about like how two stories move, the best story and the worst story. Okay, so the last case. Okay, ma'am, do we have time or should we like wrap up?
Sir, we have time.
We have time. Okay, ma'am. How long?
We have a 20 minutes of time where we can, the last half an hour can be taken for a QA session. Okay, sure. So I think we'll go with
you
can finish 5 minutes before 5.
Yeah, sure. I think good to go, man. So the last company we are going to discuss is about Sun TV. Okay. So this I have to give you a background, right? We have to give a background. So uh, so we'll start from, I think, if you are a Gen Z, okay, if you are like a 2K kid, okay, you would have not known something called as a cable TV, okay, so or a satellite TV. You would never hear this word satellite TV or cable TV, okay. See, like 20 years or 30 years before, okay, what we had was a television set, and in that television set we had a connection called as a cable, okay, a cable will be connected, and this cable only few channels you can have, like 10 channels maximum you will have, okay. So in that cable only 10 channels you can maximum watch, okay. And in so this Sun TV was one of those cable TV channels or satellite TV channels, okay. So pretty much it's like in Indian context they have been there for around 30 years, okay. So they started as a cable TV or a satellite TV company, okay. As technology kept on evolved from 1990s up to 2010, they were like into cable TV business. They also moved into FM radio business, okay. They also moved into set-up box business, okay. So now they are actually having only set-top box business, okay. They're having channels, okay. They also have like entertainment channels they have, okay, TV channels they have. But how many of us are watching TV channels now? Okay, who's watching? We watch YouTube, we watch Twitter, we watch LinkedIn, we watch what else? Instagram Reels, YouTube Shorts, right? How many of are watching TV? Okay, even if you watch TV, it's going to be what? Netflix, Amazon Prime. Okay, so that's how we are watching. So our entertainment is not cable TVs anymore. Our entertainment is not set-top boxes. Okay, that's like dead. This company is in a dead business, okay. So it's not that the company is dying, the industry itself is like pretty much dead, okay. So let's see the difference between the Paylite and Jet Airways and this company, okay. Let's see how this works out, okay. It's very curious. Let's see. Market cap is like a good amount, okay. The company is like totally worth, share market says the company is like worth 17,000 crore, okay. And the share price is 443. PE is 10. What did I tell about PE? Below 20, it's a bad business. 20 to 30, it's a average business. 30 to 60, it's a good business or amazing business. 60 and above, the market feels it's an amazing business, okay. 10 means the market is saying like this seems to be like a stupid stock, okay. This is a very stupid business, this is a dying business, it's a useless business. That's what the stock market is telling, okay. See, this 10 is calculated by the stock market, okay. You, me, everyone keep buy based upon that only. This 10, number 10 is like created, okay. So this company stock market says it's a pretty much dead business, okay. So we can't like value this business too much and all, okay. But look at their ROC seems to be good, okay. It's like very counterintuitive, right? The company is making good amount of ROC, but P is like pathetic. Okay, it's like saying that even if you score like 100 out of 100 in exam, the teacher says, no, you are not that great. Okay, you are just like you're a bad student. Okay, how can someone say like that? Okay, out of 100 you got a amazing mark, but still the teacher says no, you are not like good enough. Okay, this company is like that. It's making good profit, but stock market says no, this company is like useless. Let's see what is going on here, okay. Sales, look at the sales. Is it falling? No, it's not falling. Is it rising? Look at when this number doubles. That's why we have to look at when the number doubles, okay. 1800 doubling comes to how much? 3600. When it comes to 3600 here, almost like 14 years, okay. Compare this with Paylite. Paylite is amazing. This company is slow growing. It's growing, but it's slow growing, okay. If sales itself is slow growing, what's about profit? Profit is 1400. It has to Let's see when it doubles. It's not even doubled yet. Okay, like around 14 years and no, or not yet it doubled. That means it's like pretty much slow. It's a pretty slow. See, that's why stock market is telling that it's a bad business. Okay, stock market PE is a very important number. Okay, let's look at their net profit 691. It should double 2400. Is it doubling? Yes, amazing. Surprisingly, it is doubling. Okay, surprisingly, it is doubling. But how come? How come it is doubling? Here it is not doubling. How can it double here? Okay, let's see. So from operating profit, we add other income, deduct interest, deduct depreciation. So I think the culprit should be this guy, the income, the other income. Look at the other income. Okay, I think we got the culprit. Okay, this number is what is increasing the net profit, right? So what is this other income? See, other income is this company would have invested in other companies, right? They would have, this company will, Sun TV will get interest from loans or dividends from other companies. Okay, that is what other income. That means this company is not, okay, this company is not like focusing on their own sales, but it has become an investing company. It's investing in other companies. They're making like good amount of money. Okay, they're making good profits here. Okay, good income they're making. So sounds curious, right? This company is not at all getting, its own sales is not going high, its own profit is not going high, but its income from other companies is going high. Okay, sounds curious. What about the dividend? Dividend seems to be really good. Okay, amazing dividends and all they are paying. Okay, during COVID they stopped, but other years they are paying well. Okay, so something is going on here. We can't say it's not a good company, but it's not a bad company also. Sounds confusing, right? Okay, these middle companies are the ones which are like confuses everyone. Okay, let's look at the reserve. Reserve seems to be increasing, extremely going up. Okay, really nice. Okay, reserves are really good. Okay, borrowings, okay, nothing, no borrowings. Borrowings they have here, but it's like negligible. It's very small numbers. Okay, borrowings are very small numbers. Okay, so no borrowings, high reserve, nice profit. Assets are not growing at all. See, the money that they got as reserve, okay, has grown from how much? From 2000 to 9000. 7000 rupees of profit they have earned in 14 years. But have they invested it in assets? How much they invested? Only 500. Where is the balance 6500? 6500, boss. Where is that money? Okay, where is that money gone? Yes, that money has gone into investment. Okay, see, from 200 to 5500. How much is the difference? You'll take like 5000. So you got the story here. The company made how much of reserve of profit in 2012 to 23 is somewhere between 6500 crore. Out of 6500 crore, assets they have bought only 500. Balance 6000 is left. 5000 they have invested it in other shares and bonds. Still they have how much? 500 or 1000. Okay, that 1000 is other assets. So now, what's a curious question here? This company makes profit, not amazingly, but makes profit, makes a lot of other income. Okay, reserves are good, no borrowings. It sounds amazing. Assets are not growing, but investments are growing like anything. Okay, they have a huge amount of money in their hand. But why is stock market saying that they are not a good company? Very suspicious, right? Stock market says this is not a good company. This can come because of two reasons. One, either this company is a fraud. Okay, the stock market has found out this company is a fraud. Okay, is that true? No, this company is not a fraud. Okay, they have been in existence for 30 years. It's been run by a person of good reputation. It is like also doing well. They are also like doing really well. Okay, so that's not fraud and all here. Then what is the reason? The reason is, the stock market has a curious question. What is this company going to do with its money? Stock market needs that reason. Tell me in what way, what company you are. People are not at all watching. You are not a setup, you are a setup box company, but people are watching YouTube. So you can't say that you are a entertainment company because no one is watching televisions. Okay, people are watching YouTube. That means over the next 5 years, this company will have what? No business. Okay, stock market says, tell me what is your business. Don't tell that you are a TV entertainment business because that's dead. That's like dead. Tell me like some other business. Okay, you have to be in some other business. You have to tell like what you're going to do with all this money, all this reserve, all this investment. Tell us a plan. Until this company tells a plan, the share price will not go up. Okay, the share price will not go up. Okay, so that's the moral of the story. Stock market needs a solid story. Okay, unless they have a story, the share price will not go up. Look at the share price here. So in 2022, the share price was 420. Okay, till now, okay, till now, still I think it's just 1 year. It's not gone anywhere. If you still want, I will search in Google. Okay, I'll put it in Google and you can check. Okay, we'll take a 10 years history and we'll check. Okay, so today the company's price is around 430.
Sir, I hope we can start the Q&A session at 5.
Yeah, sure, ma'am, sure, ma'am. I think once the
Okay.
share price loads, I think I'll then
Yeah.
end it.
You can
Sure.
take up till 4:55.
Yeah, sure, ma'am. Once the share price opens, I think I can tell.
Okay, we are having a poll being launched. So by the time the share prices load, we'll have a poll being launched for our attendees. Okay, so attendees, the poll says which is not a limitation of financial accounting. The options are complies with the legal requirements. The data available is historical in nature. Lack of data for comparison of cost of operation of the firm with other firms in the industry. So attendees, you can choose your choice for the answer of the poll. The poll question says, which is not a limitation of financial accounting. Attendees also note that in the next 5 minutes, we'll have the Q&A session where our panelists will be answering to all your question answers. We have received a lot of question answers from all the attendees regarding the financial statement and analysis. Attendees also note that there are recorded sessions being available for this particular webinar on YouTube. Now it is live on LinkedIn as well. Please answer the poll and choose the answer of your choice. There were attendees asking us in the chat box that if we can rewatch this, you surely can rewatch this on YouTube. Recordings are available. Also, so far as the certificate question is concerned, dear attendees, certificate will be mailed to you on your registered email ID, the email ID with which you have registered for this webinar. You will receive the certificate in a day or two. We are very overwhelmed to see the response and the interest and the inclination showed by our dear attendees. Okay, sir, you can go ahead.
Yes, ma'am. Just one second.
So the answer for the question was 37% said a lack of data for comparison of cost of operation. 30% people voted for the data available and historical in nature. And 33% said complies with legal requirements.
Okay,
Thank
people.
you.
So yes, ma'am. So now we look at the historical share price for this company. Okay, this Sun TV network entertainment company. So in 2006 year, it was 315. Okay, then it fell to somewhere 170, or it went to 500 also. At some instance, it was even like nearing 1,000. Okay, but look at overall, like what is the share price here? Somewhere between, it is trading between like below 500 for a long time, right? Very, very long time. And the share price is still now at 437. Where it started, it is still here. For how many years? For how many years? From 2006 to 2023, 17 years, the share price never went anywhere. Compare this to the Paylite company, which looked like a mountain Himalayas. Okay, it was like looking like Himalayas. Look at this. Okay, except for this period between 2016 to 2019, only 3 years. If you remove that, I think this company is like flatly, it's trading at a range of 350 to 450 or something. Okay, so see, why is the market giving such a lower price range? Because this company is not at all, for so many years, have never told like what are they going to do about their business, the dying business, the satellite channel entertainment business. What are they going to do with? They have never said anything in the last 10 years. Okay, so market is saying unless this company is going to tell its clear cut plan for the next 10 years, we will not increase the share price, we will not buy this share. Okay, so is it a good time to buy this share? The answer is you should be like very patient, keep tracking this company. Okay, keep tracking this company. Once this company makes a solid plan and it tells to the stock market that yes, this is our plan, this is how we are going to go. Okay, if once they are given that solid plan, then this company's share price will immediately, it will double or triple from here immediately. Okay, but till that time, we never know where this will go. Okay, till that time. So which is a good business, which is a good story you guys tell? uh, a very fairy tale like happy ending, not like happy ending. Okay, it's like throughout, it's like a nice life. That's about Asian Paints. Okay, sorry, that's about Pidlite. Pidlite has a always a good life, right? Then we had a pathetic life called as Jet Airways. Then we have a confused life which is called as Sun TV, right? So there are like three stories here. Okay, one about a good person ending up in a good way, another like bad person ending up in a bad way, and the confused person ending up in a confused way. Okay, so there are three different types of stories. Which story you guys want to be a part of? That is the question. Which story you want to be a part of, or which story you want to be your life? Okay, of course we want it to be like Paylite. So buy that company's share, not like Sun TV or not like, definitely not like Jet Airways. Okay. See, it's not a share recommendation here. Okay. It's not a share recommendation here. So it's purely, it's like for educational purpose, we are like explaining it. Okay. So I'm not selling any recommendation like buy this company, buy that company. Okay. Because see, share prices are always unpredictable. They can fall at any instance. Okay. See, Pidilite till now, it's an amazing company. But tomorrow, if someone identifies a fraud in that company, that share price will also collapse. So shares are risky. That means you have like $1,000 or something. Put it in 20 different companies. Okay, 20 different companies. But all those 20 different companies should be good companies. Okay, good stories. Okay, because even if one or two stories are not going to pan out in the way, okay, there can be a fraud or something. Something can be there, but still 18 good shares or companies will save you. Okay, so that's how you have to invest. So I think from my end, my story ends here. Okay, but this is how you have to read the statements.
Thank you, sir. Thank you for your expert guidance. And what we could take away from here definitely was financial statement reading is now no more complicated. You have made it so easy for us. And I think that was a much needed insight, basically, because everyone has got some other the confusion regarding it. So you have made it very easier for us. Thank you again.
Thank you, ma'am. Thank you, ma'am.
So, sir, can we start with the Q&A session?
Yeah, yes, ma'am.
Okay. Okay, so sir, I'll just read out the questions for you and you can answer them accordingly. Dear
Okay.
attendees, please note that we have a half an hour time, which is a 30 minutes time for the Q&A session. And once that is done, basically we'll be then saying a goodbye and we'll be ending the webinar. So please ask your questions in the chat box. We'll try to answer as much as possible. Okay, so sir, the first question goes from Mizigaro Emmanuel. He says, is financial statement important in business? If yes, how can we implement it?
Okay. See, financial statement is like very important here. See, even if you take your personal life, we should have a financial statement. We should have a financial statement. Okay. Once we join a job, we have a statement, right? We have, we are like selling our services. We are getting salary. So that's our sales. Okay. From there, you deduct all our expenses. Okay. Your rental expense, your clothing expense, your entertainment expense, deduct all that. What you end up with net profit. Okay, the money that you have in your hand, your basically it's net profit is nothing but your savings, right? So you have sold your service, which we call as sales. You have a lot of expense and direct all that. You end up with what? A saving or a net profit. Okay, this savings that you have, when we keep on accumulating it, it's called as reserve. Okay, what are you going, so once you have reached a good amount of savings, a nice amount, okay, amount with which you can buy a house, what are you going to do with that money? You invest. Okay, so there are like three decisions coming here, right? You are like, you are saving your money, that's your financing. You're not borrowing. Okay, you're saving your money, that's financing. You are buying a house, that's an investing decision. So that house is going to either give you rent or save you rent. What are you going to do with that extra income or that savings? What are you going to do with that? That's a dividend. That is a dividend decision. So government. So we need to have financial statements. Actually, we should have, and we should every 6 months we should review our own financial statements, how they are.
Okay, thank you, sir. Thank you for the answer. Now, the second question is from Tony Abraham. He says, how do you invest in government institutions?
Okay, see, government institutions, we can't like fully see, government institutions have to sell their shares in the market. Okay, so there are some companies which make their shares available in the stock market. Okay, but some institutions, they never sell their shares in the stock market. So whichever is like available, you can directly buy it from the stock market.
Okay,
Yes,
that is a very good answer. So next question is from Joseph Roby. He says, what measures should be put in place to ensure that the company has negative returns? If the company has negative returns, is back to profitability?
Okay, see, there are like two problems here. One is certain companies can never come out of the profitability problem. Okay, they will be in loss. Okay, so what to say? If you take a company like Jet Airways, okay, Jet Airways, like not only this airways, any airways company has a is a loss-making company. Okay, even if they are today profitable, they will be loss because that entire sector itself is loss-making. So it's like extremely difficult for some companies to revive. Uh, See, unless the industry in which they are situated, okay, that industry should be profitable. That industry itself should be profitable. Okay, so or else it's like very difficult to run a business. It's very difficult to run a business. So if you take a company like one of the turnaround companies, what you're mentioning is a turnaround situation. Turnaround is a loss-making company moving to a profit. That's called as a turnaround. Okay, around 100 companies which are trying to turn around, only 5 companies will end up making profit. 95% of companies will again make loss and they will file for bankruptcy and they are dead. Okay, so this 5% of companies are those who are like, they have to, number one, again get finance, again they have to do good marketing. Okay, they should have an amazing product, again they should actively market that product and make some money. Okay, this is the only way to, even for a company to turn around. But as I said, like only 5% of companies turn around, other companies fail.
Okay, thank you, sir. So the next question is from Murshida Akhtar. She's saying, briefly describe about PE ratio.
Okay, see, PE ratio is like extremely kind of a complex mechanism. What I've done is to explain you it in a simple way. Okay, PE ratio tells you um, uh, how much would you pay. For example, I think I'll try to type here somewhere. I think we had your question here, right? Just one second. I'll just type. Okay, it's not that. Okay, I think I'll type the answer here. Okay, it's someone question, but just for typing, just to show you, I'll just type. See, PE is a ratio. What is that ratio? The P refers to the price. What price? The share price. Okay, the price at which from which you can buy the share from the market. EPS refers to earnings per share. The E refers to earnings per share. Earnings per share. What's earnings per share? Okay, see, it works like this. If your company's share price, okay, if your company's share price is 100 and your earnings is 10, okay, what you end up, see, it's very simple. If you are buying a company, in a year you will get 10 rupees. In a year you will get 10 rupees. How much are you willing to pay for this company? Okay, that is what PE is. PE is 10x. That means this company makes 10 rupees of profit, but I'm willing to pay 10 times the profit to buy this company. Okay, so will anyone pay like this? In stock market, it's a common thing. Okay, people will always
Yes,
pay a higher amount. Okay, so
yes,
it
yes.
becomes such a normal thing. Actually, people sometimes they ridiculously pay a huge amount also. Okay, sometimes they pay ridiculously huge amount also. For example, take this case. Okay, I think this case, 1000 is a share price. Okay, people are willing to pay. The company makes only 10 rupees of profit in a year. It's 100x. Will anyone pay this? In a year itself, the company makes how much? 10 rupees. But people are willing to pay 100 times more to get this share. Okay, so which is correct? Uh, I think no one knows an answer. Okay, even people in stock market, no one knows an answer. Okay, but roughly, what we can roughly say is something like this. Okay, uh, 20 P is what is like averagely is an average. 20 P is the average. Okay, so you can take that as an average. Anything more than 20, they are like good companies, you can tell. Anything lesser than 20, they are not like good companies. But that's a very simple explanation. Okay, we can't take that as a answer. Okay, I think that's the best I could give for
Okay.
P.
Thank you, sir. So next question is from Donald. He says, what is the formula of return on capital employed, ROCE?
Okay, I'll just type here. Okay, I'll just type and I think I'll share it. Okay. See, return on capital employed here. Okay. See, what is, first of all, we'll see like what's the, I think the formula, I think we'll put it simply here. Return. There's some profit. Return means profit, right?
Yes.
It's on the capital employed. Okay, capital employed. First of all, like what is this return and what is this capital? And we'll just like quickly see. Return is a profit, right? I think that's like very simple. Capital employed means how much of money you have put into this business, right? How much of money you put into business. How you will find that? The total money that which went into this business are only two types of money. One is equity capital, okay, and the other one is debt or borrowings, okay. So the company shares plus the debt, okay. See, both money have gone into the company, okay. For example, if you want, we'll put like this. I'll copy the same thing and I'll paste here. Look at here. The company has invested like this 50 crore or 50 million, and 50 million they've invested, okay. 100 million they've got. On that, how much of profit that the company got? So roughly we'll take, it's going to be 20, okay. So usually it's a percentage number, so it will come to, you have to multiply it by 100, so the answer will normally come to 20. So you got the idea here. For the amount that the capital that you invested, what is the return that you are getting? Okay, what's the return that you're getting? But which profit should you take? There are like so many profits, right? Right, there are like so many profits. Net profit, operating profit, gross profit, like that. What profit you take? You take a profit which is called as operating profit. Okay. So I'm not going to tell why we take that profit, but you take that profit. I think that is the idea here. Okay. And yes, ma'am.
Okay, sir. Thank you. So
Yeah.
next question is from basically this is a Uni-Athena question, so I'll be answering.
Okay.
Syed is asking that is there a short related course on Uni-Athena platform similar to today's webinar topic? Syed, let me tell you, we offer various courses from different domains. There are short courses, there are master courses. Okay,
Yes,
so
yes,
all the panelists that are there here, will send you a link in the chat box. You can visit our website for more information and the course related guidance. You'll get it on our website. Okay, sir, the next question is from Pir Bilal. He says, should the investors take into consideration the CSR activities while investing in a company?
No, you don't need to take care, because like CSR is a voluntary service. Okay, so companies sometimes they do CSR, they don't do. So it depends upon their nature. So we don't need to take their CSR activities.
Okay. The next question is from Emmanuel. He says, what is the relationship between sales expenses and operating profit?
Okay, we will look at from an individual perspective. Okay, for example, you make, I think where is Emmanuel? I think it's like move. Okay, see, your salary, okay, is like your sales. You are selling your services, right? That's why you get your salary. Okay, expenses is your daily expenses, your travel, your entertainment, your clothes, your food. Okay, that's like your expense. Okay, deduct your sales from your expense, you end up with what? As an individual, you end up with savings. But as a company, it ends up with profit. That's a difference. Okay, the names are different, the terminologies are different, but the idea is the same. Yes, ma'am. That's the idea, ma'am.
Okay. So the next question is by Johnson. Okay, so Johnson is saying, what is the interest on the profits? How do you arrive at depreciation? What is interest on profit and how do you arrive at depreciation?
Okay, see, we don't have any interest on profit. Okay, once we have profit, we can make an investment in some kind of a bond or a fixed deposit like that. Then only we'll make a interest. Okay, so it's very simple like that. You got your salary. Okay, you made all the expenses. You saved that money. Where did you save that money? If you have saved it in a fixed deposit, you will get interest. If you have saved it in your locker at your home, Will you get any interest? No. Why? Because you have not invested it anywhere. Only when you invest, you get interest. Okay. See, depreciation is like an extremely complex calculation here. Extremely complex. Okay. Even for an individual, it's like extremely complex. For example, why it's complex is uh, depreciation, okay, is something like a reserve. Okay. It's something like a reserve. Okay. Not exactly a reserve, but it's a reserve. Okay. So you buy a mobile phone, okay, something like iPhone. Okay. How many years do you think an iPhone will work? Roughly, I think 4 years. Then you will sell it. Okay.
4 to
So
5 years.
yeah, 4 to 5 years. So what you do is you take the total amount, right? You divide it by the total number of years in which you expect it to work completely, and then it's like you can't even sell it, okay, because it becomes such an old model, you can't even sell it. Okay. That means every year the iPhone has a depreciation. You have spent the money in the first year itself, but it is depreciating every year. So we have to tell, like, what is your expense that is happening. Okay. So it's not only that iPhone you have a iPhone, you have a computer, you have a bike, you have a car. Everything differs in the depreciation. So it's a very complex calculation here. I think it's best you leave it to accountants. Okay. But the from our perspective, we only identified how many variables: sales, expense, operating profit, net profit, reserve, borrowings, and assets. Okay. Only when you couldn't understand the story within these 7 elements, we try to figure out the other ones. Okay. Most all companies will fit within these elements. So depreciation, I think you can just leave it. It's like it's reserved for the accountants.
Okay. So next question is from Vikas Singh. He says, how reserve come under liability?
How
Why are
reserves?
reserves how reserves come under liability if they bought some reserves from profit?
Okay.
I think this was
Yes,
while
ma'am.
you were discussing the case.
Yes, ma'am. I think it's an extremely nice idea. Okay. See, mm, uh, we'll put it like this. I think I'll show you the statement. You will get an idea. Okay. I think your question arises from this part. Okay. So
Yes.
why is like profit of a company put under liability side? Okay, not on the asset
Yes.
side. So we put it like liabilities. See, company is an artificial person. It's not a real person. It's an artificial person. It does not have any money on its own. Okay, a company does not have any money on its own. So it borrows from people. It can borrow in two ways. One, it can ask for people, real people like you and me, to invest in it. Okay, so that's called as share capital, right? It is so whose business it is? It is we are the owners of the company because we have invested in the company. But company is an artificial person. It cannot. It is only like what to say. It's an agent for us. Okay, it's our agent. Okay, so a company cannot have any money on its own. It does not have any money on its own. We gave it money. We bought its shares. Okay, so we are owners. Okay, so either we are owners by giving share capital, okay, buying shares, or we can also like lend money to the company. We become what? We become lenders. The company is a borrower. Okay. In both the terms you look at, the company is not having its own money. It's either got money from borrowings from us, or we have invested the money. Okay. See, from the company's perspective, who are we? Is it does the company owe us money? Yes, the company owes us money in terms of shares that we have invested. If shares itself is ours, okay, if we are the 100% owner, the reserve is also ours, right? So it actually owes all this money to either people like us, okay, to the shareholder, borrower, banker, lender. So it only owes the money to other people. That's what is liabilities. But with that money, it can buy the assets. It can buy assets. Okay. But who's the owner of this asset? We are the owner of the asset. The shareholder is the owner of the asset, but we are not like directly buying it. We are using a agent called as the company. Okay. So company is an artificial person. Okay. So who cannot have money on his own names. He cannot have money on his. He cannot like create money. How can a company create money? Okay, we are the owners. We are appointing a company to make money for us. I hope you got the idea. It's a little bit confusing, but I think that's the best way I could explain.
Okay, sir, thank you. So next question is from Benjamin. Benjamin says, what are the limitations of financial statements?
See, there are like lots of limitations here. One, there can be frauds. Okay, but we trusted the company. We trust the company because they've been like for many years. They use good auditors. Okay, good accountants is used. So we trust them that
Okay, dear attendees, I think we have a technical glitch here. So we'll just, please bear with us. I think the faculty will join back in. Okay, I think we have a question from one of the attendees saying, can't find transport and logistic course, please help. So basically this answer will be given by the panelists. So panelists, please put up the course link for transport and logistics. Okay, so our attendees wish to find a course on transport and logistic. Okay. Then there are some questions which I'm having related to Uni Athena. By the time faculty joins in, we'll be answering those questions. Okay. So there is Kenneth D. Barclay saying joining from Liberia, Africa. Thanks you all. Thank you, Kenneth. We are really grateful that you joined us today and hope this session helped you. Okay, then I am taking a few more questions. I'll also answer a subject related question here. Basically, Olubumi is saying, how can a company like Jet Airways suffer from this loss? So Olubumi, basically, if you check the Jet Airways history, you'll get to know that they had been suffering huge losses. Their investments were very drifted in terms of having liquidity. And if you go on and read about it, the owner had placed a lot of money in loans, which they hardly could recover. There were bank frauds. So I think that is the reason Jet Airways suffered this loss.
ma'am, can you hear me? I think I've lost the
Yes, sir.
connection there.
Yes, sir. Yes, sir. We
Okay,
can
ma'am.
hear you. So, sir, the next question is from Oswald. He says, uh, okay, this is the Uni Athena question. Is financial analysis required at risk management programs? Okay, so you can answer this. Hello, is financial analysis required at risk management programs or
Okay,
risk
see,
management companies?
okay,
I
ma'am.
think.
So, see, a company faces a lot of risk. Okay, so it can be an operational risk. For example, take an airline. Okay, see, airlines operational risk is your baggage getting lost, or the airplane is not like departing on time, or the airplane meeting an accident. Okay, these are like the operational issues. There are also like financial problems, right? See, operational risks you manage through operational risk management. There's also financial risks. Okay, there is also financial risk. Okay, so we need to study like financial risk also. Okay, how and all a company will suffer. Okay, with various types of risk. So risk, within risk management we have like a lot of risks being covered: operational risk, financial risk, like that. So financial risk is like 50% of a company here.
Okay. Sir, we'll take
Yes,
two
ma'am.
more questions and maybe
Yes,
then
ma'am.
we'll have the Uni Athena PPT being displayed.
Okay, ma'am.
Okay, so sir, one of the questions is, can you name few CSR activities by any of the companies?
CSR activity, like if my internet is like bad, that's the only problem here. Okay, you can type like this company's name. Okay, and you can search. Okay, I'll just like show you. Just one second. Okay, CSR by ITC. So there's a company called as ITC, right? Indian Tobacco Company, and they do a lot of CSR activities. And what they do is they sponsor schools, they construct schools, okay, they give free textbooks, okay, like that. You could have heard a product name called as Class Notes. I think it's Classmate. Okay, Classmate notebooks. Okay, so that Classmate is produced by ITC company. So they do a lot of CSR activity. See, unfortunately, it's not working here, but they are also into. He is a farmer knowledge also. Okay, so they tell farmers like how to grow their crops, how much of pesticides to use. Okay, that kind of training sessions also they conduct. Okay, so many companies are doing like CSR activities. Tata is like one of the foremost
Okay.
one. Okay, yes, ma'am.
Okay, so the last question we are taking up for today. So the question is from Trevor Poole. He says, what are the most important skills to be a good financial analyst? Though it is out of our subject specialization, but yeah, sir, we would like
Okay,
you to guide us on it.
so you should like love numbers. Okay, I think we've shown you a lot of numbers, right? We showed you a lot of numbers. See, there is a pattern among the numbers. So if you at the start itself, if you're going to get a fear of the numbers, then you should not be a financial analyst, because a financial analyst is a numerical analyst, right? He should love numbers. Okay, so that, and you should understand like the relationship. You should be like, one, good with numbers. You should love numbers. Two is you should be like extremely good in logical thinking. Okay, so from where this reserve came, why is this company like not borrowing a lot, why is this company having less fixed assets, what are they doing with the surplus profit? Okay, see, these are like very logical questions. But if you are like extremely creative person, okay, you might not have a logical question. Okay, so your love for numbers and your logical thinking are two things which will make you a financial analyst.
Okay, so thank you. Thank you so much for the
Yes, ma'am.
insightful session.
Thank you, ma'am.
So dear attendees, thank you so much for attending and giving your valuable time to us. Just waving goodbye to all of you. We have something to just inform you about. So as you all know, we are Uni Athena and we are offering courses across all domains from professional to academic. And the basic, very important feature that we have with us is like it's affordable, flexible, and accessible. So our partner universities come from UCAM, come from Aberte UK. We have GMU. We have GMU also conducting the convocation ceremonies. If there are learners with us, if you are learner with us, you might know it better. And we have accreditations to various universities where we offer courses from. Okay, so our offerings are basically domain specific. They are from masters, MBA, microcredit courses, the doctorate courses, and we have ranging from basic to essentials to mastering to diploma to executive diploma and MBA essentials. So basically all our short courses are learn for free courses and they have got basic hours, okay, so from basics to 40 hours diploma. And going ahead, I think we have these features which are unique to us. Why choose Uni Athena? So we have these features. It's a flexible payment option. There is a pay as you go option. The learning is 100% online. It's self-paced. You don't need dedicated hours of time to, give to us. You can have your own flexibility. We have accreditations across various partner universities. The module course delivery is completely online. And there is a personal tutor connect, which is peculiar. Anytime you enroll with us with any of the course, you have a specific tutor dedicated for you and to guide you throughout the course. So basically, we have lesson video tutorials for you. We have essential reading. There's a huge range of learning resources that we provide once you enroll with us. Okay, and this is a bite-sized delivery completely because we don't bombard you with the excess information. We give you all kinds of practical exposure to that particular field. And going ahead, I'll just let you know that we have a lot of additional reading material once you enroll with us and you start learning with us. It is entirely curated for the learners to get a hands-on expertise and practical exposure. So this is how the learning portal looks like. So you can have a glimpse of it. And going ahead, you can check our website offerings on www.uniathena.com. I'm sure by now all the panelists must have helped you out with, the different courses, the offerings, the recordings, the certificates. Okay, and for more information, I would always request you to write to admissions@uniathena.com or Fatima @uniathena.com. So this was us, Uni Athena. So have a very good weekend, everyone, and take care of yourselves. Thank you so much for joining us today.